The Nasdaq is currently closed, but the last reported closing price for REZOLVE AI PLC under the ticker RZLV was $2.64 in after-hours trading on December 3, 2025, reflecting a slight positive movement of 1.15% from its prior closing. Now, that number, $2.64, is merely a footnote in the recent volatility, which is the real story here. The immediate expectation for any AI-focused small-cap stock that announces a major acquisition is usually a lift in market cap, driven by excitement over scale and synergy. But REZOLVE's reality was a sharp and immediate drop of over 10% on the day the Crown Peak acquisition was announced. This is the first critical insight. The market isn't buying the headline synergy. It's reacting with fear to the debt structure of the deal, which is a major signal for deeper scrutiny. The general belief orbiting RZLV right now is a split narrative. The bulls are citing the immediate accretion to adjusted EBITDA and the massive scale provided by Crown Peak's blue-chip client base and $70 million in expected annual revenue, validating management's brain commerce strategy. They see a company rapidly consolidating the digital experience platform space and layering on its proprietary AI technology, the so-called Brain Suite, to create a comprehensive end-to-end commerce solution. But the contrarian, and frankly the more immediate market reality, is that this $240 million enterprise value deal, comprising $90 million in initial consideration and the assumption of approximately $150 million in Crown Peak debt, has raised serious red flags about the company's balance sheet health. The market is challenging the cost of growth, especially when short-term obligations already exceed liquid assets, indicated by a low current ratio. This is not just a growth story anymore. It's an execution risk story tied directly to a substantial debt load and the complexity of integrating a large new asset immediately. Looking at the recent stock movement, the reaction to the acquisition was a textbook sell-the-news event, amplified by underlying financial concerns. Following the announcement on December 1st, the stock plunged, and while it clawed back slightly in the after-hours session leading into December 4th, the daily volume leading up to and immediately after the news was significantly elevated, suggesting a substantial institutional rotation and heavy retail trading activity. Over the last month, the stock has been in a clear downtrend, falling over 34%. Yet the prior 6 months saw a surge of over 40%, illustrating the whipsaw nature of high-growth, speculative small-cap technology names. This kind of movement, massive surges followed by a sharp and sustained retreat, is exactly what generates tension between market expectation and financial reality, forcing a critical look at what drives the price. Much of this pressure stems from a consistent pattern of short-selling activity, which brings us to a crucial dimension of this stock's trading profile. REZOLVE AI is currently facing demonstrable short-seller pressure. The most recent short interest data available shows the short interest percent float hovering around the 10% mark, which is a significant figure for any stock, signaling that a notable portion of the free-floating shares is being actively bet against. Beyond the raw percentage, the off-exchange short volume ratio has been exceptionally high, frequently exceeding 40% and sometimes spiking well over 50% in daily sessions. This indicates that a large chunk of the daily shorting activity is being routed through non-exchange venues, often associated with more aggressive or institutional shorting tactics. Actionable insight here is that investors should look at the fail-to-deliver data, which has recently shown fluctuating but sometimes sizable quantities, suggesting difficulties in settlement that can be a hallmark of concentrated short positions. The short borrow fee rates, while variable, also act as a real-time gauge of demand to short. A sharp spike here is a warning sign that the pool of available shares to borrow is tightening. The short thesis, as articulated in various reports and inferred by market behavior, is straightforward. The company's valuation, despite a significant year-over-year revenue increase of over 300% in the last 12 months, is unsustainable given its persistent unprofitability, high operational burn rate, and the new substantial debt assumed with Crownpeak. The argument is that while the top-line growth is impressive, the bottom-line reality and balance sheet risks are too great, and the Crownpeak acquisition merely accelerates the cash-burning trajectory while introducing significant integration risk. A counterpoint is the strong analyst consensus. 6 firms currently rate the stock a strong buy, with an average price target around $10. Citing the $160 million in projected annual recurring revenue post-Crownpeak, and the successful early adoption of its stablecoin payment processing, which has already cleared over $1 billion in transactions in regions like Brazil. But analysts focus on the long-term vision. Short sellers focus on the short-term fragility of the balance sheet. This discrepancy is the core of the market's current debate. Do you think the short sellers are right this time, or are they pushing fear? The business model of REZOLVE AI PLC centers on what they term brain commerce, an AI-driven platform designed to unify the end-to-end consumer experience from product discovery through transaction, leveraging their proprietary large language model and brain checkout functionality. Essentially, they are aiming to make commerce truly conversational and automated, moving beyond traditional e-commerce models. This is where the Crownpeak acquisition fits in. Crownpeak is a digital experience platform with a large established enterprise client base. REZOLVE is buying the pipes and the customer list, then planning to upsell their high-margin AI brain suite into that existing footprint. This strategy of a roll-up, where a traditional profitable asset is acquired to serve as a high-volume distribution channel for new AI features, is compelling, but it is heavily dependent on execution. If the integration of Crownpeak is messy, or if the cross-selling of the Brain Suite to established DXP customers proves slower than management projects, the debt burden will quickly become a major drag, and the short thesis gains serious traction. Investors interested in tracking this tension should monitor specific signals. The days-to-cover ratio, which measures how many days of average trading volume it would take for short sellers to buy back all borrowed shares, is a key metric. A rising days-to-cover, currently about 1 day but highly volatile due to low liquidity, could indicate the potential for a short squeeze if a significant positive catalyst hits. In the coming weeks, look closely at institutional filings. Any significant new 13F or 13D filings, either from institutions taking a large new long position or an activist short firm disclosing its bet, will provide clarity on where sophisticated capital is heading. Retail sentiment, particularly on platforms like Reddit's Wall Street Bets or various financial X channels, is also highly engaged with REZOLVE, often viewing the price action as a coordinated attack and calling for transparency. While retail coordination is difficult to maintain and often overhyped, the shared belief in an unfair system does add volatility. Investors should be cautious of simply chasing a squeeze and instead focus on the fundamentals. Is the Crownpeak integration proceeding smoothly? And are the debt covenants manageable? The future outlook for REZOLVE is a high-stakes bet on execution. Scenario 1, the bullish case, sees the Crownpeak acquisition rapidly assimilated, its $70 million in revenue stabilizing the company, and the Brain Suite upselling generating substantial new annual recurring revenue, validating the company's target of reaching $500 million in ARR by 2026. This would see the stock re-rate closer to the analyst's $10 average target. The second scenario, the reality check, involves integration headwinds, higher than expected interest costs on the assumed debt, and slower adoption of the AI suite by Crownpeak's conservative enterprise clients. In this case, the stock could test its 52-week low of $1.07 as the market discounts the high-growth story in favor of balance sheet solvency. The key catalyst to watch in the immediate term is the next quarterly financial report, as it will provide the first look at the post-acquisition consolidated financials and the impact of the new debt. The opportunity here lies in the genuine strength of the BrainSuite technology and the impressive client list CrownPeak brings. The risk is purely financial and operational. The current $2.64 valuation suggests the market is pricing in a significant discount for that risk. For those of you who are watching this AI sector closely, comment below how many shares of REZOLVE AI PLC you currently hold and what your long-term price target is. It's crucial to understand the conviction behind these positions. In summary, the narrative for REZOLVE AI is one of massive expectation clashing head-on with an equally massive financial reality. Management's bold vision